Warren Buffett famously said dividends are proof that your investments are working for you even while you sleep. But here's the truth. Dividends aren't just extra cash. They're a lifeline. Meet Eric. He was drowning in bills and struggling to make ends meet until he discovered monthly dividend stocks. Those steady payouts didn't just help him pay rent. They gave him a new lease on life. If you're ready to learn how dividend investing can change your story, stick around. This could be the turning point you've been waiting for. In this video, we'll talk about first, why companies pay dividends and what monthly dividend stocks are. Second, the advantages of investing in monthly dividend stocks. Third, the selection criteria. Fourth, 6 monthly dividend stocks that could help pay your rent, so you won't want to miss this. Let's begin by understanding why companies pay dividends. It's simple. Dividends are a way for companies to reward their shareholders and show appreciation for their trust and investment. Essentially, it's their way of saying, "Thank you for believing in us." Now, let's talk about what monthly dividend stocks are. Many dividend stocks pay out dividends quarterly or annually, but monthly dividend stocks, as their name implies, pay out every month. These stocks are popular for people like Eric, who want steady cash flow to cover rent and bills, or even you can reinvest for more growth. Why did everything begin to change when Eric discovered monthly dividend stocks? So what are the advantages of investing in a monthly dividend stock? First, they provide a reliable monthly income stream. For Eric, it was like having a second paycheck that didn't require clocking in. Whether the stock market was up or down, the dividends kept rolling in, giving him peace of mind and financial stability. Second, dividend-paying stocks are usually more reliable. The companies that pay these dividends are often market leaders with strong, consistent revenues. For Eric, that meant he could trust these companies to keep delivering, even during tough economic times. And the third game changer, they're inflation-adjusted. Companies that issue high-quality dividend stocks often have a competitive edge in their industries. They can adjust their prices to stay ahead of inflation, and as their profits grow, so do the dividends. This meant Eric wasn't just keeping up with inflation, he was staying ahead of it. So what are the selection criteria? Eric knows that not all dividend stocks are created equal. To pick the best ones, he followed a set of smart criteria. Let's break them down so you can do the same. Dividend yield. This is the percentage of a company's stock price that it pays out as dividends. Dividend payout ratio. This metric shows how much of a company's earnings are paid out as dividends. A healthy range is typically 40 to 60%. Dividend growth rate. This shows how much the dividend has increased over time. Look for stocks with at least 5 years of consistent dividend growth. Business stability. Companies in stable industries, like real estate REITs, utilities, or consumer staples, are often the best candidates for monthly dividends. Track record of payments. Consistency was key. Eric focused on companies with a strong history of paying. 6 monthly dividend stocks that can pay your rent. Before we dive into the list, make sure you hit that like button and subscribe to the channel. Your support keeps us motivated to bring you the best financial tips and strategies every week. Now, let's explore these stocks, moving from lower to higher dividend yields. Number 1, Stag Industrial offers a dividend yield of around 4.40%. Stag is a real estate investment trust, REIT, that focuses on industrial properties like warehouses, distribution centers, and manufacturing facilities. These properties are the backbone of industries like e-commerce and logistics. Stag makes money by renting out its industrial properties to businesses that need large spaces to store and move products. With the rise of e-commerce giants like Amazon, the demand for warehouses has skyrocketed, and STAG benefits directly from this trend. They generate revenue through long-term leases, ensuring consistent income. Eric asked himself, will this company grow? The answer was a resounding yes. There is also huge growth potential. The U.S. market for industrial properties is estimated to be $1 trillion. As of now, Stag only has about 0.5% of that market. E-commerce and logistics are booming, and companies will always need warehouses to store products. Stag also has a diverse portfolio, with 573 buildings in 45 different industries located in 41 states, reducing the risk of relying on a single industry. Number 2, Realty Income Corporation offers a dividend yield of around 6.01%. Realty Income is a real estate investment trust, REIT, that owns and manages over 15,450 properties across the U.S. and internationally. These properties include retail stores, industrial spaces, and even healthcare facilities. Think of tenants like Walgreens, 7-Eleven, and FedEx as big, dependable names. Realty Income dares to refer to itself as the monthly dividend company. Here are a few things to know about it. 11% average annual total return since 1995, 652 consecutive monthly dividends, 108 consecutive quarters of dividend hikes. Realty Income's secret lies in its triple net lease model. This means the tenants not only pay rent, but also cover property taxes, insurance, and maintenance costs. For Realty Income, this results in steady and predictable cash flow with minimal expenses. Even in the darkest days of the pandemic, Realty still collected about 85% of rents, rebounding to 93.6% by the end of 2020. Earnings and revenues increased for the year because of acquisitions. Of course, the economy came roaring back and is still holding mostly steady. The stock is still priced well below pre-pandemic levels and even significantly below its 2022 highs, while earnings are better. Number 3. Armour Residential REIT offers a dividend yield of around 15.49%. Armour Residential REIT is a mortgage REIT that invests in residential mortgage-backed securities. These include securities issued or guaranteed by U.S. government-sponsored entities, GSEs, like Fannie Mae and Freddie Mac, and Ginnie Mae securities, backed by fixed-rate and adjustable-rate home loans. Armour earns money from the spread between the interest it earns on its mortgage-backed securities and the cost of borrowing to finance those assets. For Q3 of 2024, Armour achieved an average interest income of 4.89% on its assets. The company reported a net income of $62.9 million, or $1.21 per common share. Armour has potential, but also understands the challenges. As interest rates stabilize, Armour Residential REIT could deliver steady payouts. However, its performance is heavily influenced by economic conditions and interest rate fluctuations. It remains a high-risk, high-reward option. Number 4. AGNC Investment Corporation offers a dividend yield of around 15.43%. AGNC invests in agency mortgage-backed securities, MBS, on a leveraged basis. It includes residential mortgages, collateralized mortgage obligations, CMOs, and non-agency MBS, with many backed by government-sponsored enterprises like Fannie Mae and Freddie Mac. The company earns through the spread between interest on its MBS and borrowing costs, leveraging its investments for higher returns. AGNC reported a net income of 39 cents per share and comprehensive income of 63 cents per share. With strong financials and reliable payouts, AGNC offered ERIC consistent income and portfolio stability, even during market shifts. If stability and high yield appeal to you, AGNC is worth considering. Number 5. Oxford Square Capital offers a dividend yield of around 16.97%. Oxford Square Capital is a business development company that invests in loans and collateralized loan obligations, CLOs. Its portfolio is diversified across industries, with a focus on software and business services. Oxford Square generates income from interest payments on its loan portfolio and cash distributions from its CLO equity investments. In Q3 of 2024, the company reported $10.3 million in total investment income, slightly lower than the previous quarter. ERIC noticed that Oxford Square faces some challenges, such as fluctuating interest income from its debt investments. However, its focus on high-yield CLO equity investments provides a cushion. With a weighted average yield of 13.7% on its debt investments, the company remains well-positioned to generate consistent returns. But ERIC decided it was a valuable addition to his portfolio for the potentially high monthly income and to diversify investment. Number 6. Orchid Island Capital offers a dividend yield of around 18.37%. Orchid Island is a mortgage REIT specializing in residential mortgage-backed securities, RMBS, issued or guaranteed by U.S. government-sponsored enterprises like Fannie Mae and Freddie Mac. Orchid Island earns income from the spread between interest on its RMBS portfolio and borrowing costs. Recently, the company reported a net income of $17.3 million, $0.24 per share, for Q3, a major turnaround from a loss of $80.1 million in the same period last year. Orchid Island's success hinges on the interest rate environment. While rising rates can challenge its margins, its hedging strategies provide a layer of protection. Eric added Orchid Island Capital to his portfolio for its high yield, but balanced it with more stable investments. There you have it, 6 monthly dividend stocks that could help you pay your rent and build a steady income stream. But always do your research and consider your risk tolerance. Thanks for watching, and I'll see you in the next video.